right. Good morning. Welcome back to a Thursday episode with Talking CRE. I'm Lawrence King, and I'm here with my co-host,
Dusty Bates, commercial broker.
Today, we got a good one today, Dusty. So this is kind of leading up from last week's discussion regarding landlord property owners that are kind of getting to the end of dealing with multifamily or portfolio properties in general.
Yeah, a lot of owners who are aging, and they're what I've found, especially with multifamily owners, is they're concerned about their heirs and what they're going to do with the portfolio of especially multifamily properties that they've owned. They managed them for 30 years. Their heirs have not. What do I do with them? I exchange out of those and into lower management assets like net lease properties, and that's where the 1031 exchange comes in.
Right. And so the 1031 exchange, Dusty, that's kind of like the middleman in between the sale of the multifamily into triple net lease, for example, right?
Yes, and there's a lot of rules that are involved with that. That's why we have our guest today, who can explain the rules of that game and how to not get in trouble.
All right. Well, without any further ado, our guest today is Russell. Russell, we're going to add you to the show right now. Let me see if we can get him in. There we go. Russell, good morning. Well, I think it's morning where I'm not sure where you're located, Russell.
It's good afternoon. I'm right near Dusty.
Okay, perfect. Oh, yes, afternoon. I'm sorry. Yeah, my timing's off.
You haven't had enough coffee today, obviously.
I think I'm on my third one, actually. Welcome to the show. This is Talking Commercial Real Estate. Everything on here is regarding commercial. And tell us a little bit about you, who you are, what you do, and how long you've been in the business. Give us the good stuff.
Yeah, thanks, Lawrence. Yeah, it's great to be here today. Thanks for inviting me as a guest. So I'm Russell Marson. I'm Senior Vice President with Investment Property Exchange Services. We're also known as IPX or IPX1031. We're the largest qualified intermediary in the entire nation. That's all we do is handle 1031s. And I've been doing it for 27 years. So we're all here together for a short time period this morning. Probably going to go over a lot of information pretty quickly. So the most important thing that your folks can remember is my phone number. And they can call me anytime they have any questions. I also teach accredited courses for CPAs and attorneys, so I'm a free resource for the client's tax advisor as well.
Wow, that's good to know. It's very, very good to know. Good connection, Dusty.
Yeah, well, and I call them for all of our exchange stuff. They are the one across the nation that we use. And we'll have his information at the end if you guys need it.
Okay.
And I encourage you to call them with any questions. They're always helpful. Whenever I asked him a really weird question, off the wall question, was that yesterday about a really wild exchange, and he had the answers ready to go right away.
It's good to know. And the biggest thing is having someone personally to answer that phone when we have those questions. It's difficult nowadays to get one person that and you can call on at any time. Well, not any time, but in a respectable manner. But it's one person. You're not getting tossed around to different people. So this is perfect.
No, you're always going to have me as a resource. And you're actually right when you say anytime, because my phone number, as Dusty knows, is my cell phone number, and you guys can reach me anytime, right? I'm a tax nerd. So by default, okay. I don't have a life. So you'd be giving me a life by simply calling me and asking me tax questions.
No, I mean, out of respect, we'll respect your time and call you in a business hour-like manner. Obviously, we've got something burning and out, stuff is going crazy, then yeah. But I appreciate that. So tell us a little bit more about the 1031 exchange. Dusty kind of gave me a little bit of insight to different properties that you can change over to triple net leases we were discussing, or net leases in general. Tell me how that 1031 exchange happens, and how do we get started with that? Who do we contact? Obviously you, but how do we get going with that?
Yeah, so actually, let's just kind of set the premise for a second for those of you out there that are not familiar with 1031s. The 1031 exchange is actually the greatest wealth building tool in the entire Internal Revenue Code, right? It allows real estate investors to reposition their real estate assets throughout the course of their entire life without having to pay taxes. Because as you guys were talking before you introduced me on, you were talking about heirs, which, of course, about estate planning. Well, as you go through life, your objectives change. early on it's maybe appreciation, later on it's cash flow, later on it's less management headaches like the triple net lease or estate planning, right?
Mm-hmm.
Those objectives, as those objectives change in life for your investors, the 1031 allows you to pivot, right, to those different types of assets that meet whatever the current financial objectives are. That's why it's the greatest wealth building tool in the entire Internal Revenue Code. So on average, especially California, California is the heaviest tax state, right? 35% is kind of the average tax paid. So 1031 allows you to defer that and not have to pay that.
So eventually, later on, when you do decide to sell, you're going to get hit with that hefty.
I'm glad you brought that up, because really what you're really alluding to is that, taxes are inevitable, right? Because we've all been told that. I can't count the number of times tax advisors have told my clients, just pay the tax now, because you're going to have to pay them sooner or later. It's not the case. Current taxes are not inevitable, right? The current estate tax law is incredibly favorable. Less than 0.1% of all estates in this country pay any estate tax, because the floor is currently $11.5 million. So if you're single and your estate's below $11.5 million, there's no estate tax. If you're married, it's double that, $23 million. And your heirs get a step up in basis. And this is the really cool part. So if you bought a property, if I bought a property 50 years ago for $100,000 and I pass away yesterday, which makes this webinar awkward. So I passed away yesterday. The basis is stepped up to the fair market value as of the date of my passing, which is now, right? So they can immediately sell the property after they inherit it. They don't need to do an exchange, right? They have no tax consequence because their basis is $2 million. That's fair market value, and they're selling for $2 million. There's no profit. There's no gain there, right? So taxes are not inevitable. That's why we say that.
That's cool.
Yeah, so don't let your clients cash out of real estate. Just help them exchange into something else that better suits their current financial objectives.
So so if I pass away, let's say tomorrow, and my assets.
By the way, it was great knowing you.
Knock on some wood. So if I pass away tomorrow, all my assets, anything that I purchased, let's say 20 years ago, they're up in value now. I can pass it on to my heir, my son. And he can sell them immediately. Hopefully he wouldn't, but he can sell them immediately and not pay any.
Not pay zero capital gains tax.
Capital gains, just to say.
Yeah.
No.
All
gains, still gonna pay taxes.
All the depreciation recapture and capital gains would be forgiven. I mean, so long as your estate's below that $23 million, it's all completely tax free. So that's a huge thing.
Now you said $23 million. That's if I'm married, correct?
Yeah.
Do both have to pass away?
Well, it's the total estate, right? And the basis is stepped up. So if one spouse passes away, then the basis is stepped up, right? And then it transfers to the next spouse, and then so you'll get a step up in basis, but it depends. But if you become single again, and then you sell down the road, then you're at the threshold of 11.5 again.
11.5.
Right? But a lot of the basis would have been stepped up, so a lot of that tax is forgiven.
Okay, so that's 23 million for married, 11.5 million for single.
Currently, yep.
Currently, so that can change over time.
Yeah, absolutely.
Okay. Does that change every year, or is that something that's consistently the same amount, like going across, or does it go up?
It's been the same for a while now. It's adjusting up a little bit for inflation every year, but it's been the same for a while. It'll inevitably change, but there's never been some kind of floor, right, on it. So there'll always be some kind of. I doubt they would ever get rid of step up in basis. What they might do is, lower the floor down to 6 million or who knows what, right? Something like that. So they might play with that, but there's nothing on the table now. So we'll see what happens.
Got it. And so who, let me ask you this, who's in charge of changing these numbers? Like who, obviously someone has to be in charge of voting on this and all that good stuff. Right. Yeah. I mean, most people probably don't know anything about 1031 exchanges. I'm just going to lay it out there, right? Mm-hmm. And who's in charge of that, right? Mm-hmm. So is it, you don't know if it's voted on like every year? I mean, every 4 years or every 8 years?
You're talking about, are you specifically talking about the estate tax or 1031?
The estate tax.
Yeah, it's not voted on every year. It's just, if, politicians, they come up with, like the Jobs Act back in 2017, the Recovery Act. I mean, right, they always come up with these different bills, and the bills have multiple things in them. Some stimulus, some pay-fors,
Okay.
right? And so it just depends on what they see as being, when they look at estate tax, they typically are looking for as a pay-for, right? So if they reduce it in the future, they're going to say, well, okay, we're looking to reduce in the future because that way it's more revenue to the Treasury, so that way they can spend it on the other part of the portion of whatever bill they're trying to put out there. But it's impossible to predict.
Okay. I didn't know if there was something they every 4 years they change, or however. But okay, perfect. Dusty, you got any questions?
Well, I think another question. So we know that you can exchange out of a property, it's an investment property, into another one. You can take your money from one side, put it into the other. IPX comes in as the third party, almost like a middleman escrow.
Mm-hmm.
Money goes in there. You don't touch it. It goes out into the new place. I know like kind is something that's been changed over the years. How has that changed, and where is it right now as far as what I have and what I can replace it with?
Right.
Yeah. So first of all, let me address the first part of that question, and that was kind of the structure, we're the middleman per se, right? So in a 1031 exchange, we have to set up the exchange. It has to be in place prior to closing of the relinquished property. The relinquished property is the property being sold by the exchanger, right? So we can't open an exchange until they're actually under contract with a buyer and they've opened escrow. And then at that point, we just have to set up the exchange sometime before it closes. And it has to be in place before it closes. If they close without an exchange in place, they have a failed exchange. They can't do an exchange. They have a fully taxable event that can't be unwound. What happens is, so you can visualize it, we assign into the escrow as the seller on behalf of the exchanger. That gives escrow instructions to wire funds to us when it closes. And we set up at closing, we set up a segregated commercial bank account that we name the client on also. And those funds just sit there static in that account, waiting for them to get into contract on a replacement property. And then once they do, we assign into that escrow as the buyer, which gives escrow instructions to receive funds from us. So we're the ones, kind of the middleman that has to control and safeguard the funds and put all the exchange documents in place as per IRS regulations. And then your second question was the like kind. I don't know if you want to skip to that slide there. I think it'd be like the fourth or fifth slide in there.
And while Dusty's doing that, I want to touch on something really quick. All of my proceeds when I sell, do they have to go into 1031 exchange, or can I take 20% out? And will I get
Yeah, actually stop right there, Dusty, because go forward one. There you go. Yeah, so that's to Lawrence's question. So if you don't want to pay any tax, three things have to be equal or greater. So if you sell for $1 million, you got to buy for $1 million, right? If you buy for less, it's okay. Just understand you're going to pay tax on the difference, right? It's called taxable boot if you buy down in value, if you touch any money. But three things have to be equal or greater if they don't want to pay any tax. One is the purchase price. Mm-hmm. So sell for $1 million, you got to buy for $1 million. Well, actually, that's not 100% correct. You do get to subtract out those non-recurring closing costs. So your commissions, title and escrow fees, transfer tax, those things reduce that equal or greater number. So if you sold for $1 million and those costs were $50,000, $950 is the equal or greater mark you need to buy for, right, to defer all tax. The second thing that's equal or greater is the proceeds. That simply means all of the cash, right? All of the cash that comes from the closing has to be the down payment on the replacement properties. Any cash that goes into the exchanger's pocket, they're going to pay tax on it. It's okay to do. People do it all the time. Just understand whatever money you touch is going to be taxable. And the third thing that has to be equal or greater is the debt. That one, just from a math standpoint, kind of makes sense, right? Because you sell a property for $1 million, $500,000 was a loan that was paid off at closing. So there's $500,000 of cash proceeds that came into the exchange, right? And they have to buy for $1 million again to be equal or greater. So how are they going to do that? They're typically going to take on a loan, right?
Right.
And the exception to that is that you can replace debt with outside cash. So if that same client had $500,000 of cash in a savings account. They can pull that money in and buy their $1 million property all cash. They wouldn't need to take on any debt in that case. But those are the equal or greater requirements for an exchange.
Okay. So if I do take out a little bit of that percentage of that money, I'm getting hit with the capital gains tax on that little small amount.
Just that amount. Yep.
Got it.
The rest of it was deferred. It's not an all or nothing deal, right? You
Right.
can do a partial exchange.
Okay. Perfect.
When we're talking about taxes, we're also talking like like the capital gains tax, but also depreciation recapture, right?
Yeah, depreciation recapture is a bigger tax actually. It's a higher percentage tax. Yeah, because capital gains to the feds is taxed between 15 and 20%, depending on adjusted gross income of the taxpayer. And then the state, whatever state, the property is being sold in, California, 13.3 is the highest tax rate in California. It's of course tacked onto that as well. But depreciation, which you just stated, the recapture of depreciation is also taxed, and that's taxed at a higher rate. So you have, capital gains is based on appreciation.
Right.
So you bought it for $1 million, you sold it for 1.5, you had $500,000 of appreciation, that's taxed as capital gain. Well, while you own the $1 million property, you depreciated it several years and you took $500,000 of depreciation against the property. You lowered your basis by $500,000, right? Mm-hmm. So the $500,000 of gain is taxed as gain. The $500,000 of depreciation is also taxed, but it's taxed at a much higher rate than the gain. That's taxed at 25% to the feds, just a flat rate. And then the state doesn't care if it's appreciation or depreciation. It's just income to the state. So it'll be taxed at 10 to 13%, right? And there's also on top of that the affordable healthcare tax, which is 3.8% as well. So in California, the uppermost tax bracket can actually be over 40% in taxes.
Over 40%? You said?
Over 40%. Yeah, if you have over $1 million of gain, you're going to be in the uppermost bracket, and you're probably going to be paying over 40% in taxes.
So we definitely need to get your number. Make sure we have your contact for anyone in the state of California at this point.
Anywhere in the country, actually. So, I
mean, I
handle exchanges everywhere.
This is true, which we're global. So
you've got an issue right now with the interest rates going up where people, Lawrence, in commercial, you don't fully amortize the loans. They're due in 5, 7, or 10 years, amortized over 25 or 30. So you've got a situation right now where people have a 4% loan that's coming due next year. Yeah, and it's going to jump up to 7 or 8%, and that their cash flow is wiped out. Now, they have to exchange regardless because of this issue, right? They can't just cash out because then there goes 40% of their money.
Right.
And so it's a good time if you're getting into commercial to start going after those listings and helping them reposition that money through an exchange.
Sure, absolutely. Yeah, pre-planning, and that's why it's really important to sit down with your clients and make sure that you ask them, hey, what other real estate do you own? Because as their broker, you guys want to position yourself as their financial planner for their real estate holdings. So you want to analyze all of their real estate holdings and see what's going on in there, right? To make sure that each one of those assets are meeting their current financial objectives. Because if not, you're going to encourage them to sell those properties and they help them exchange into something else. And you bring up a great point, Dusty. That's a part of the analysis, right? Is seeing the debt service and what's happening with that and how that's going to play into the net operating income in that asset in the future.
Right. Now that leads us into what is like kind.
Yes.
What can I sell? What can I buy? And I think there's the slide. Here it is.
That's it.
So what can I sell and what can I buy? And how's that changed over the years?
Yeah, this is a huge thing. And it actually, believe it or not, it actually hasn't changed over the years. The perception is over the years that it's changed, but the reality is it's just been clarified. For example, I actually started in real estate sales 33 years ago. And one of the first classes I ever went to was a 3-hour 1031 class. And the educator that was teaching that class 32 years ago said, like kind is you have to sell residential income for residential income, commercial for commercial, raw land for raw land.
Right. That's what I was thinking.
You couldn't intermax it, right? That's 100% false.
Okay.
And it's never actually been the rule. So much so that the IRS had to come out with clarification, right? Saying, no, this is the way it's always been, but hey, here's actually what is like kind. Like kind, all real estate is like kind with all real estate. And this is huge. It's not what a property looks like that makes it like kind. It's how it's treated. If a property is treated as business or investment property, it's like kind with any other kind of business or investment property. So that means land, for example. If you have people that own land, they have potentially no income coming off that land if they're not ranching it or farming it. They can't take depreciation because there's no improvements on it. So they are great to solicit and discuss, hey, you've got this land is worth $500,000. I can help you free up that stagnant equity, and you can exchange into improved property. You can buy a fourplex, a small commercial strip center, whatever, right? Go into a triple net lease. Now you have cash flow coming off your $500,000 you didn't have before. Now you have depreciation to shelter the income tax due on the income from the asset. And you have a faster appreciating asset in a lot of cases too. Most people don't know they can go from land to improved properties. In fact, I can't count the number of times I've had tax advisors tell my clients, you can't sell raw land and exchange into improved property. It's not like kind. That is 100% false. So all of these asset classes you see on the screen, they're all like kind with one another. And that's the beauty of 1031, right? For the most part, a lot of these assets have different types of financial objectives. So the 1031 allows you to reposition to those different types of objectives that better meet whatever your current financial objectives are in life at this time.
So and thank you for that clarification, because I've always thought that too, and I was told that too before.
Yep.
So let me ask you this. If I have, let's say, 3 investment properties, I want to sell those properties, put them in a 1031 exchange, and I want to purchase my house in Beverly Hills for my own personal use. Can I do that? Is that like kind?
No, you can't exchange into a personal use property. So there's really 2 types of properties you cannot 1031 into or out of. One is a personal use property. So that'd be, your primary residence.
Right.
Although that being said, the IRS did create a safe harbor revenue procedure back in 2008 that outlines how to convert a property to and from personal use to business use after an exchange, which is really cool because it's a recipe that shows somebody how to use the 1031 exchange to buy that dream home in Beverly Hills. And so here's what the revenue procedure states. It's very simple, actually. So sell your investment properties, buy your very expensive property in Beverly Hills. For the first 2 years after the exchange, and that's the time period, for the first 2 years, you have to treat the property 2 ways. One is you have to limit your personal use to 2 weeks a year or less, or 10% of the rental history, whichever is a greater number, right? So if you rented it on Airbnb for 300 days a year, you could personally use it for 30 days a year. And also keep in mind, if you're going there to work on the property, that's not a personal use visit. That's a maintenance visit. So there's ways to use it for more than 2 weeks a year. But nevertheless, that's the first thing you have to do is limit your personal use. Second thing you have to do is show income on it. But that's a crazy low standard. I only have to show 2 weeks per year of income on it. That's it.
2 weeks per year?
2 weeks per year. That's it. So
wow.
if you don't need the income on it and you don't want full-time tenants in there, you could literally leave it vacant. I can rent it to my buddy Dusty for 2 weeks a year, claim that on my taxes. After I do that for 2 years, after 2 years, I can do whatever I want. I can move into it as a primary. I can treat it as a pure second home or vacation home. I never have to rent it again, ever.
That's huge.
It is huge. It is huge.
So I can Airbnb it for 2 weeks and move in afterwards.
Well, no, you got to wait 2 years.
Oh, right. Okay.
You can, yeah. Don't jump me there.
Right. Okay.
Yeah, you got
full disclosure, 2 years.
Yeah, you have to do 2 weeks for each of the first 2 years.
Okay.
Right. And then after 2 years, go for it. Move into it. Your exchange is safe harbor. It can't be overturned if you follow that revenue procedure.
Perfect.
What about my investment properties that I bought? Like say I exchange into one of these duplexes, and then how long do I have to wait before I can do it again? Or what are the rules there?
So how long do you have to wait before you can sell it again and do another 1031?
Correct.
Yeah, so that's a great question, and that's a very different question than what we've just been talking about, because we're talking about how to convert properties to and from personal use. Your scenario, Dusty, has no personal use. It's just how long does an investor have to hold a property before they can sell it again and qualify with a 1031. There actually is no stated time period. The IRS has never created revenue procedure that states this is how long you have to hold a property before you can 1031 it again. And let me be very clear, they never will define that because they don't care about time, they care about intent.
Got it.
So, I mean, there is no stated so it kind of falls back on the tax advisor. Like, how long does the tax advisor feel this client should hold it? Most of them seem to think 1 year is safe. So, buy the property, hold it, get a little rental history, and then hold it for at least a year and sell it, and you should be fine. I've seen case law where it's been perfectly fine to sell in less than a year. You need to be able to establish intent, and really, because you don't want to look like a flipper.
Right.
That's the other type of property, right? There's two types of properties I said don't qualify. Personal use, also inventory or flipped properties don't qualify 1031 deferral. So if you buy a property with a 1031, you need to get a little rental history into it first before trying to sell it.
When you say a little, is that like 2 years or
there's no stated time period?
There we go.
Right? So I would say own it for at least 1 full year and get some rental history in it.
That's what you would advise, right?
That's what I would advise. But they, once again, I will always tell them, hey, you can't take my word for it. You still have to talk to your CPA to see how they feel about it. But that's.
Yeah, and I think we got a question here from Sharon Wu. For a 30-year lease, does it have to be 30-year, or what's the minimum year lease to be qualified?
Yeah, so that's one of the categories on this slide at the bottom right-hand corner. There is that 30-year lease. A 30-year lease, once a lease is 30 years or more in length, it becomes fee simple equivalent. And therefore it's like kind with real property for 1031 purposes. So if you have a client that's selling a lease and they want to buy fee simple, they want to buy, their own building, right? They don't want a lease, then they can. But what happens is there needs to be 30 years left on the lease. It's not the original term of the lease. It's what's left on the lease. It needs to be 30 years or greater. But it does include options to extend that are transferable. So if there's 25 years left on the lease, but there's a 5-year option to extend that's transferable to any buyer, that's 30 years. And that's fee simple equivalent and like kind.
Okay.
Cool.
Hopefully that answered, Sharon, hopefully that answered your question on that one.
So that covers like kind. What about the time frames when you're going through an exchange? We haven't covered that, I don't think. What are the different time frames?
I can just talk about that. Was back on an earlier slide, but we don't have to go to it. Yeah, so like I said, we have to set up the exchange before it closes, right? Once it closes and the exchange is set up, now their clock has started. So they've got 45 days to identify and 180 days to close. Those are calendar days. They're not business days. So it doesn't matter whether those deadlines fall on a holiday or a weekend. You don't get the next business day extension, and they're hard set by the IRS and can't be extended. The only extensions that are ever allowed are for federally declared disasters. We're actually just coming off one in California from the January floods that pushed most deadlines all the way to October 16th. So we literally had some exchangers that had a year to do their exchange because of it.
They got lucky, man.
They got
really lucky.
They got really lucky.
Well, we got Hurricane Hillary coming, I think, this weekend. So hopefully we don't have a big disaster like that, like we did before. But
so is Hillary Clinton's coming? What?
No. His name is Hurricane Hillary.
So any of the big fires we have here in California or floods or anything like that, they all COVID caused an extension. Any federally declared disaster creates an extension for 1031 purposes.
How long was
that's not very common, right?
Well, it's yes and no. There's several of them issued every year, but you're right from a standpoint, it's not common because typically not that many actual exchangers get to claim that, right? Because in the scope of all exchanges, very few are impacted by that. But there are several issued right now. In fact, we just got one issued for floods in Mississippi. So Yeah, there's always ongoing ones based on whatever you see in the news. Whether
Maui?
it's disasters, Maui is not yet, but it will. I promise you, they will be under a federal declared disaster very soon.
Yeah. Excellent.
Wow.
Okay. What other question, Lawrence? What about the different types of exchanges? There's different ways to do this, right?
Well, there's only, the 1031 exchange, the most common 1031 exchange is what we call the delayed exchange, right? And that's where you sell a property and buy a property. And you got the 45 and 180 days between closings to do so. There's also what's called a reverse exchange, right? And that's where you buy a property first because you found your dream property and the seller wants to sell it to you, but the seller's not going to give you time to get your property sold because you haven't even listed it yet. And so you're forced into buying something first. Then we can do a reverse exchange. But even that exchange has to be set up before the property being purchased closes. You can't just buy a property, then afterwards say, hey, I want to do a reverse exchange. And that type of exchange is really complicated because we have to go on title to the property, which we don't do in a delayed exchange. So we're creating LLCs to hold title. We're triple net leasing those properties back to the exchanger. There's just a lot of layers to it. So it's a lot more expensive of an exchange. But nevertheless, it's a possibility if your clients have to buy something first. And then the other kind of exchange is what we call a build-to-suit exchange or an improvement exchange. And that's where maybe your client sold for $1 million. They bought something for $500,000. They're going to pay tax on the $500,000 difference. They don't want to buy another piece of real estate, but they would love to use the $500,000 to improve the property they're buying. Right. So we can do that. Same thing. We're going to go on title to the replacement property when it closes. And then we're going to act as a construction lender to pay the draws to the contractor as they're hitting those different phases and improving the property. And then once the improvements are done, we deed the property to the taxpayer so they go on title to the $1 million property. It sounds, yeah.
Sorry, I didn't mean to cut you off.
No,
I wanted to ask you about that. Are there any fees on those draws? If I take, want to do construction, are there any fees on each draw that I take?
Not from our standpoint, no. Just the transaction itself is a lot more expensive. So like just a regular standard delayed exchange, sell one, buy one, total cost for that exchange is only going to be $1,250. That's it. The reverse exchange, most reverse exchanges are going to run between $6,000 and $7,000.
That's a big difference.
That's a big difference. The improvement exchange, probably between $7,000 to $9,000. Wow. So yeah, you're ramping up each time, right? Because there's significantly more layers that we have to execute on those types of exchanges.
Does it matter how much money's involved in the exchange? Like if it's $1 million project or a $20 million?
No. You mean as far as our fee?
Correct. Yeah.
Yeah. Yes, it does. Yeah. The more expensive the property, the more the fee would be. That is correct.
Okay.
Okay. So generally, like those kind of fees that you're talking about are probably like 5 or 10 million or less.
Yeah. Yep. Yeah. Agreed. Yep. Probably so. And then they're quoted. The client will know the fees before they ever decide to pull the trigger. And so where it begins to make sense for somebody to do an improvement exchange is if the improvements are in excess of $50,000, right? Because that's when this is below $50,000, just pay your tax. That's going to be less expensive than the fees.
Right.
If it's more than that, okay, there's a delta, right? There's some savings above the tax, whatever the tax consequences would have been.
And I think we got another question here from Sharon. Can we do the concurrent closing for exchange? I want to back that question up with how long do you need or your company need before we close escrow to get involved? That's always been my question.
Yeah, so it has to be set up. The exchange has to be set up prior to closing. It's not uncommon for me to get a call from the closing table, right? Where they're literally signing off on the last document and they're saying, hey, we should do an exchange. I say, okay, great. The escrow officer will send me the information. Within 20 minutes, we can have the docs redrawn and they can go ahead and sign. We call that a rush, right? We'd prefer to have some time on it, but it just has to be in place prior to closing. A regular delayed exchange can be set up really quickly if need be. I mean, we like to set up the exchange closer to the beginning of escrow, just so we have time, right, to address things if we have to. But it can be right before closing too. The reverse exchange, different animal, right? We can't do that one right before closing. We typically want about 2 weeks to set up that exchange because we have to set up LLPs.
Yeah, to take title.
We can rush it faster on a reverse exchange than 2 weeks if the exchanger's paying all cash for the replacement property.
Okay. And I think so. Sharon's question was, can we do the concurrent closing for the exchange? I believe the answer is yes. Correct.
Well, I think what she means by that is, and correct us if you're correct me if I'm wrong, Sharon, is I think what you mean is, can you close the relinquish and the replacement on the same day? I'm thinking that's what you're saying. So we also refer to that as like a simultaneous exchange. Yeah, you can close them on the same day. We do need to know that in advance, right? Because normally in an exchange, the relinquished property closes, funds are wired to us, which can take 1 to 2 days for them to show up on our account. And then they're available in our accounts to go ahead and wire back out. So we want a good 2 to 3 day spread in there. But if somebody says, no, we need to close concurrently same day, replacement and relinquished property, great. Then what we do is we give escrow on the relinquished side instructions to wire directly to the replacement escrow and bypass us. But that needs to be in place before closing. So we need to know in advance that we're setting up as a simultaneous exchange. But yeah, it can be done. Absolutely.
Very cool.
Cool. Man, that's trying to take all this in all at once. So
what about
go ahead, Dusty.
I was going to ask, there's also the different rules for exchanges, or there's a couple different sets of rules. One, just like the delayed exchange, are pretty much always used. What are the different rules for doing an exchange, like identification rules? I'm sorry.
Oh, okay. Yeah, thanks. Identification rules are same for a reverse exchange or a forward exchange. It's just that in a reverse exchange, in most cases, they're not needed. Because it's easy to identify, because in a reverse exchange, you're buying first, so you're selling afterwards. So all you're doing is identifying the property you're going to sell. That's super easy. In a delayed exchange, yeah, there's 3 rules of identification. And which rule a client uses will be dependent upon how many properties they actually want to buy. Most exchangers are only buying 1 or 2 properties. So in that case, they use the most common rule, which is called the 3-property rule. The 3-property rule allows an exchanger to identify 3 properties of any value. They can be $1 billion each. Now, some people go into an exchange knowing they want to buy more than 3 properties, right? They're selling a $2 million property. They want to buy 4 $500,000 properties. Okay. You can't use the 3-property rule because obviously it doesn't work. So you have to use the 200% rule, which is the second most common rule. The 200% rule states you can identify any number of properties. So there's no cap to the number of properties, but there is a cap to the total value. All of the properties you identify can't exceed 200% of the value of the real estate you sold. You sold a $4 million piece of real estate. You can identify $8 million worth of replacement properties, no matter how many properties that consists of. Those are the 2 rules that everybody uses. There's a 3rd rule. You're never going to see it used. I've seen it used twice. It's called the 95% exception rule, and it's kind of a catch-all. So if a client says, I'm going to buy 5 properties, and those 5 properties are worth more than 200% of what I sold for. Okay, well, they're over the 3-property rule. They're over the 200% rule. So then they have to use the 95% rule. That states they have to close on 95% of what they've identified, which is everything. I don't know why they didn't call it the 100% rule.
That's like, you can identify 20 properties and then close on 19, I guess, right?
Yeah, exactly. Yeah, that would work maybe, depending on the values. But yeah, and if you don't close on 95%, the entire exchange fails. It's not even like you get a partial exchange. I've seen it used twice where a client was buying a big portfolio of real estate from one seller, and they were either going to buy that whole portfolio or nothing. And that portfolio exceeded the other 2 identification rules. So, you you'll never see that one used. And actually, it's not really important for everybody out there to know the identification rules, because when I talk to your client, I'm going to be the one that's going to help your client to determine which rule is best suited for the exchange. You guys don't need to worry about that.
You're right. Yeah. This is way over.
Yeah, you don't need to do that. Don't need to go there.
I've used over the whole career, and almost everything I've done has been exchanges. I've used the 200% rule once. Everything else is the 3 property rule.
Yeah, it's more common once you get higher in values, right? Once you get to 2 million and above, a lot of people end up using the 200% rule.
And Dust, you probably deal with this with the triple net lease situation a ton.
Yeah, well, the 3 property rule comes into play every time. 200% rule only on, like he said, over $5-6 million.
Right.
Does it even become a consideration? And usually not that. Usually you've got a couple, maybe 2 that you want to buy. And usually they're buying up. So they may be buying 2 that's going to buy up so they can keep that depreciation rolling forward.
Rolling it, yeah. Wow, Russell, you're a wealth of knowledge, and I appreciate you getting on today, and I appreciate the time, obviously. Dustin, you have any more questions for Russell before we let him go?
Well, Russ, I don't know that there's any other kind of baseline things we should talk about with exchanges.
Did you want to talk about the DST?
DSTs, that's right. Okay,
yeah,
so
I think that's a good one to talk about. If we can spend maybe 5 minutes on it, would that be okay?
That's perfect.
Sure.
I want to respect your time.
Why don't you roll to the last slide?
Okay. And let me take a stab at this, Russell.
Sure.
DST, Delaware Statutory Trust.
You got it. You nailed it.
I got that from Dusty.
That's 2 left. Well, back one again. I'm sorry. Right there. There we go. Perfect. So one other thing, just before we didn't touch on, well, just briefly, is 1031 is federal. So 1031 can cross state lines, right? So your clients can buy and sell in all states. They can sell it if you have any Exodus clients that are leaving the state and they want to buy in Tennessee or something like that. They can do it with a 1031, right? They defer both state and federal tax. They can reposition anywhere in the country. In fact, you can sell one property in California and you can buy like half of Tennessee. It's pretty cool. So let's talk about the DST though. The DST is kind of it's an exit strategy. And I know Dusty's alluded several times to the triple net lease properties, which are a great way for somebody to go passive. But what happens is some people want to go what I call ultra passive, right? Because even if you buy, a triple net lease property, you still own the property, right? You still have some duties and responsibilities. In a DST, you have literally 0 duties or responsibilities. So it's for somebody that wants to completely retire from active real estate and just receive monthly cash flow. And they don't want to have to make any decisions about selling or managing or anything like that. A DST, which as Lawrence said, is Delaware Statutory Trust. It is a fractional ownership interest in an institutional grade asset. So this is going to be a $90, $100, $120 million asset somewhere in the country. And so if your client is selling a $1 million property, and it can be anything, it can be residential income, it can be land, it can be commercial, and they can exchange into, so if they sell for $1 million, and let's say they've owned it forever and they're selling for $1 million and there's no loan payoff, so they have $1 million of proceeds, just to make the math easy for me. When they buy into a DST, and this is something that you kind of alluded to in the very beginning too, with from a standpoint of, hey, how do I get more depreciation? But if they sell a $1 million property that they've fully depreciated, they have no depreciation left on it, right? So they don't have anything to shelter the income due on it. If they're buying into a DST, when you buy in a DST, most DSTs are leveraged by about 50%. So the sponsor company, and these are these multi-billion-dollar corporations that buy and manage these assets, like Inland, Pasco, Evergreen, BlackRock. These are some of them. And so, they buy a $100 million asset, they put it into a DST, and then they sell fractional ownership interest in it. Well, they put 50% of their own capital out, and then they get a loan for the rest, and then they sell after that's all in place, right? So when you buy in, if you're buying in with $1 million of cash into that kind of asset, you're not buying $1 million slice of the DST. You're buying a $2 million slice because you're automatically assuming that 50% debt ratio without having to formally assume the loan or qualify for it. It's also non-recourse financing. So, it doesn't show up on your credit report, and they can't come after you if for some reason the property defaults. And it's a cookie cutter deal in a 1031 because a lot of 1031 clients have to replace debt. And in this case, if they were retired and they don't qualify for a loan, it doesn't matter. They're going to be able to replace debt without having to qualify for the loan. And you sold for $1 million, you bought a $2 million slice of the DST. Your appreciation when it sells is based on the $2 million. Your depreciation is now based on the $2 million. So if you bought the property originally for $100,000 and sold it for $1 million in a 1031, and you bought into a DST, and you bought for $2 million into this DST, you have $1 million of brand new basis to depreciate, brand new schedule, right? And I mean, these properties are fantastic from a standpoint of just going 100% passive, because the owners of the properties have zero duties or responsibilities, and they're not allowed to have any kind of cash call either. So if there any repairs done to the property are needed, the owners cannot be asked for one penny. So it's 100% passive. And there's typically like a 4 to 7 year life cycle in them. They're going to be resold when the market's right. And when they're sold, let's say 6 years down the road, then the owners get the appreciation based on their percentage of ownership. And now they have another 1031 opportunity at that time, right? So they can 1031 into another DST if they like that passive structure. They can come back into, to Lincoln and buy traditional real estate there, right? It's just another 1031 exchange at that point.
Right. So get your exit points if you wanted to, or you can just kind of roll it forward and keep it passive.
Yeah, you can keep it going into the next DST with another 1031 exchange. You can do.
I've used these mostly for like leftover funds in an exchange, right? So we have like 200,000 left over, $250,000 left over. We don't want to go buy a house to rent, so they'll park it with a DST, and then they don't have to pay the taxes, and then they get to just here we guys get some new depreciation a little bit, right?
Yeah,
so that's been helpful.
That's a great reason, really. So this structure of the DST was formally approved back in 2004 by the IRS as like-kind replacement property for 1031 purposes. So we have a lot of history with the DST. But there's really 3 reasons that I've seen people go into them for the last almost 20 years now. The most common one was just because people want to retire from active real estate, especially people coming out of residential income properties, right? They're like, I don't want the headaches of tenants anymore.
Right.
So I just want to go into something passive like this. The second reason was really caused by the pandemic, because once we hit that low inventory market for those couple of years, and even still to some extent now, exchanges fail at a much higher rate when there's a low inventory market, because people can't find replacement properties in the 45 days. So what we saw a lot of people do during the pandemic was they would use the DST as a bailout. They tried to find traditional real estate in the 45 days and they couldn't. So on day 43, they said, nah, we're not playing this game. We're just going to pluck it into a DST. And then we'll see what's going on in the market when it resells 4 to 7 years from now, and come back out and buy traditional real estate again. And then the third way is exactly what you described, Dusty, and that is as a sponge, right?
Yep.
You sold for $2 million. You had $300,000 left in your exchange. What are you going to do with it, right? Put it into a DST so you don't have to pay taxes on it.
And how? Remind me, I might have missed it. How long do you have to keep your funds in that DST until, if you want to pull it out and buy another asset? How long do you have to keep it inside the DST?
So it's not like a REIT, right? Because in a REIT you're buying stock that you could resell anytime you want. Right, you're buying into this trust. You're buying fee simple ownership, so you own property. You can't. These are illiquid assets. You can legally sell your interest anytime you want. It's just it's not practical. There's not a secondary market established for it. I've seen it happen several times where, if I needed to get out because I had to do something else with the money and I was desperate to do so, then I go to the sponsor company. They tell all the owners, hey, Russell wants out. Who wants to buy him out? And then I can sell my interest. But it's just, you don't end up seeing the full benefit of, why you went into that asset if you do something like that. But you can legally sell it early. It's just, you need to wait for it to sell. And like I said, its average life cycle is like 4 to 7 years. It will sell. I've seen them at a lot less than that. I'm doing exchanges for about 6 exchangers now that are coming out of one. They were in it for less than 3 years. But you kind of gotta have to go into the mindset like, hey, that money's gonna be locked up there for that time period.
Right. No, I was just saying as far as kind of like a loophole, if I'm not able to find a replacement property for the 1031 exchange, I just throw it in there really quick.
Yeah.
and then gives me more time.
It's a common question because what you're describing is like a parking arrangement, right?
Right.
I'm going to park my money somewhere until I can find something I really like. And I wouldn't recommend the DST for that because when you sell, if you sell early, you're probably going to take a little bit of a hit.
Yeah. Is it a larger hit than capital gains?
Well, it just depends on how much gains you deferred, right?
Yeah,
and where the economy is when that asset is selling, right?
Right. That's true. Because I was thinking, why wouldn't everyone do this so they're not underneath that, that time frame to hurry up and identify a different property or multiple properties in one? 45 days? I
kind of like the timing right now for the DST from a standpoint of waiting out the market, right? Because there's mixed schools of thoughts. Some economists will say, nope, we're going to see a recession. We're going to see, a real estate downturn in prices. I have other economists that say, nope, inventory is still low. Demand is still high. We're not going to see real estate, lowering or crash. So I don't know which one's going to happen, but I wouldn't mind. It's not a bad, I don't want to pay $200,000 in taxes. Right. So I'm gonna bail out. I'm gonna go into the DST and I'm gonna earn some really nice passive cash flow for the next 4, 5, 6 years. Right. And then when it sells, I'll look around and see what's going on. Right. Because typically, if you look at if we're around that bubble, right, then typically, 4 to 7 years after a bubble, kind of a good time to buy normally.
Right. Yeah.
Right. Maybe you've seen some adjustment by then. So I think timing wise, it's not bad at all.
Yeah. Okay. Yeah. I'm glad we actually covered this. Thanks, Dusty, for reminding. So thank you, Russell. Russell, how do we contact you? Where are you located on? Are you on social media at all? Probably.
Yeah. So there's my phone number, my email address right there. Definitely bookmark my website, which you see there also, which is the IPX1031.com/Marson. That'll take you to my personal site within our massive website. We've got all kinds of resources on there. Our newsletter is fantastic for you guys to use on social media. And I know Dusty's seen the stuff like, we came out, this extension thing was huge. But we always, every month, our newsletter comes out with something different, like it's investor kind of tips, right? How to buy your dream home with a 1031 exchange, crossing tax years with a 1031 exchange, going from land to improved property, all kind of mixed use properties, all kind of stuff like that, right? So we have all kinds of resources that you guys can use to share out there on social media or in any kind of mailing campaigns you have.
Awesome. So let me get I'll scan.
And if you guys, can I say something? If you guys enjoyed the talk today and you guys wouldn't mind doing me a favor, you can put your camera to that little QR code there. Absolutely. And do a little review on there. You can use words like 1031 genius, he's Brad Pitt's doppelganger. I don't know.
Oh, get this. Perfect. This is awesome. I'm going to make sure we give anyone that's watching this, if you're not watching it live, you're rewatching it, please reach out to Russell. His contact information is right there. Russell, I appreciate this time. Thank you so much for coming on and giving this wealth of knowledge. This is amazing. And thank you, Dustin, for bringing me in.
Thanks for having me on.
No problem.
Right.
Well, everything commercial real estate. Russell has provided us with some great info on 1031 exchanges. Dusty, next week, we need to go and rewatch this before next week's show. This is a ton of knowledge. And every Thursday, 1 p.m. Pacific Standard Time, same channel, everywhere, Talk CRE.
That's right.
Thank you so much. CRE. Take care, gentlemen.
Take care. You guys have a great weekend.
You too.